Hello and welcome to The Sleepy Scientist. I'm so glad you're here. Tonight we're going to explore a story that's equal parts fascinating, perplexing, and utterly modern. It's about a company that makes cars. Yes, but it's also about dreams, obsession, and how a few hundred characters typed into a phone at midnight can move billions of dollars in the blink of an eye. This is the story of Tesla, and the man behind it, Elon Musk. Perhaps you've wondered about it too. How does a car company with a fraction of the production of century-old giants become more valuable than all of them combined? How does a single tweet from a CEO send shockwaves through global markets, evaporating or creating billions in moments? Where are you right now? What city, what quiet corner of the world are you listening from? And what time is it there? Maybe it's the soft hours of evening, maybe the deep quiet of night. Tesla's story began in a moment like this. In darkness and stillness, with an electric dream. Tonight we're taking a gentle journey together. A slow, thoughtful exploration into one of the strangest phenomena in financial history. We'll meet believers and skeptics, dreamers and short sellers, fortunes made and lost on nothing but faith and tweets. I do hope this video isn't so interesting that it keeps you awake, but if it does, well, at least you'll have learned something remarkable along the way. A fair trade, I'd say. Before we begin, if you enjoy these slow science journeys and you'd like to help this channel grow, I'd be grateful if you tapped the like button, subscribed, or even just left a comment telling me where in the world you're watching from. It helps more than you might think. All right, take a deep breath. Settle in. Let the day's worries fade into the background. Let's begin our quiet voyage into the theater of Tesla, where reality and belief dance on the edge of reason, and where the line between genius and madness has never been thinner. The year is 2003. Silicon Valley is still recovering from the dot-com crash. Investors have learned, painfully, that not every internet company with a catchy name and ambitious promises will change the world. Many have lost fortunes. The air smells of caution, of burned fingers pulled back from hot stoves. In this atmosphere of skepticism, a small group of engineers gather in a modest office in San Carlos, California. Their idea is simple. Almost laughably so in hindsight. They want to build an electric car, not a golf cart, not a glorified toy, but a real car, fast, beautiful, desirable. The founders are Martin Eberhard and Mark Tarpenning. They're inspired by a few things: the EV1, General Motors' short-lived electric vehicle that was controversially discontinued, the lithium-ion battery technology emerging from laptop computers, and a sports car called the T0, a small electric prototype that proved speed and electricity could coexist. They named their company Tesla Motors, after Nikola Tesla, the Serbian-American inventor and electrical engineer whose work in alternating current changed the world. It's a fitting tribute. Tesla, the man, was brilliant, visionary, and tragically underappreciated in his time. Tesla, the company, would follow a similar arc, at least in its early years. But here's the thing. Eberhard and Tarpenning weren't wealthy enough to fund the dream alone. They needed money, serious money. Building cars isn't like coding software. You can't prototype a vehicle in your garage with a laptop and some pizza. You need factories, supply chains, testing facilities, regulatory approvals. You need millions of dollars before you sell a single unit. Enter Elon Musk. In 2004, Musk was already wealthy from his previous ventures. He'd co-founded PayPal, which sold to eBay for $1.5 billion. His share of that sale gave him the capital to pursue bigger, stranger dreams, and Musk had plenty of those. He was already working on SpaceX, his rocket company aimed at making humanity a multiplanetary species, but he had bandwidth for one more obsession. When Musk met Eberhard and Tarpenning, he saw something that resonated deeply. Electric cars weren't just about environmentalism or reducing oil dependence, though those were nice side effects. They were about proving that the future didn't have to be boring, that sustainable technology could be sexy, fast, and aspirational. Musk invested $6.5 million in Tesla's Series A funding round, becoming the company's largest shareholder and chairman of the board. He wasn't the founder, not technically, though this would become a point of bitter legal contention years later, but he was the money, and in Silicon Valley, money often writes the narrative. From the beginning, Tesla's strategy was unusual. Most car companies, if they were going to build an electric vehicle, would start with something affordable and practical. A commuter car, a family sedan, something to ease people into the transition from gasoline. Tesla went the opposite direction. They decided to build a sports car first, expensive, exclusive, and thrilling. The logic was sound, if counterintuitive. By targeting wealthy early adopters who valued performance and innovation over price, Tesla could generate revenue and buzz while perfecting the technology. Then, with experience and scale, they'd move down market to more affordable models. This became known as the master plan, a phrase Musk would later formalize in a blog post. Build a low-volume, expensive car. Use that money to build a medium-volume, medium-priced car. Use that money to build a high-volume, affordable car. And along the way, provide solar power and batteries to accelerate the world's transition to sustainable energy. It sounded simple. It would prove to be anything but. The first car, the Tesla Roadster, was based on the Lotus Elise chassis, lightweight, nimble, beautiful. Tesla would strip out the gasoline engine and replace it with a battery pack and electric motor. On paper, it seemed straightforward. In reality, it was a nightmare of engineering challenges. Batteries overheated, range estimates proved wildly optimistic. The transmission, a critical component, kept breaking, costs spiraled out of control. What was supposed to cost around $70,000 per car to produce ended up costing over double that, and yet, the price to customers remained fixed, meaning Tesla lost money on every single sale. By 2007, the company was hemorrhaging cash. Eberhard, the CEO, was blamed for cost overruns and missed deadlines. Tensions rose. The board, led by Musk, pushed him out. Eberhard was devastated, later filing a lawsuit claiming he'd been unfairly scapegoated. The legal battle was messy, bitter, and eventually settled out of court with an agreement that allowed 5 people to call themselves co-founders, including Musk. It was an early sign of something that would define Tesla's story: drama, endless, exhausting, public drama. Musk took a more active role in the company. In 2008, he became CEO. It was a pivotal year, and not in a good way. The global financial crisis hit, credit markets froze, investors fled risky bets, and Tesla, burning through cash with no clear path to profitability, was about as risky as it got. Musk faced an agonizing choice. He had money, but not infinite money. He was funding SpaceX, which was also on the brink of failure after 3 consecutive rocket explosions. He had Tesla, which needed tens of millions just to survive the next few months. And he had his own personal finances, strained by a bitter divorce. He could save one company, maybe, but not both, or so the conventional wisdom said. Musk, in a move that would define his public persona, chose to double down on both. He poured his remaining fortune into Tesla and SpaceX, borrowing money to cover personal expenses. It was all in, a gambler's bet, with no safety net. On Christmas Eve 2008, both companies were hours away from collapse. SpaceX's 4th rocket launch succeeded, earning a critical NASA contract. Tesla closed a financing round on Christmas Eve itself, securing just enough cash to survive. Musk later described it as the worst year of his life, and that's saying something for a man who's had rockets explode and factories catch fire. But they survived, barely, and in surviving they earned something more valuable than money. They earned mythology. The Roadster, despite its troubled birth, was a revelation. It was fast, 0 to 60 in under 4 seconds. It was beautiful, and it was electric, with a range of over 200 miles, far beyond what skeptics thought possible. Celebrities bought them. George Clooney drove one. So did Arnold Schwarzenegger. It appeared in Iron Man, driven by Tony Stark, a character explicitly modeled on Musk himself. The Roadster proved that electric cars didn't have to be slow, boring compliance vehicles. They could be objects of desire, and that psychological shift, that change in perception, was perhaps Tesla's greatest early achievement. But the Roadster was never meant to be the endgame. It was a proof of concept, a stepping stone. The real challenge lay ahead: building a sedan, a family car, something that could compete with the mainstream giants. In 2012, Tesla launched the Model S. If the Roadster was a statement, the Model S was a declaration of war. It was a full-sized luxury sedan with performance that embarrassed sports cars, a range that quieted the critics, and a design that looked like it had arrived from the future. The Model S could accelerate faster than a Porsche. It had a 17-inch touchscreen that controlled nearly every function, eliminating buttons and making the interior feel like a spaceship. It offered over 250 miles of range, later extended to over 300. And it could be charged at Tesla's growing network of superchargers, stations that could add hundreds of miles of range in under an hour. Reviews were ecstatic. Motor Trend named it Car of the Year. Consumer Reports gave it a near-perfect score, then briefly retracted it due to reliability concerns, then gave it back again after updates. It won awards, top safety ratings, and attracted a devoted fan base unlike anything the auto industry had seen. But here's the thing, Tesla was still losing money. Lots of it. The Model S was expensive to produce. The company was building a factory in Fremont, California, a massive facility formerly operated by Toyota and GM. They were developing new technology, expanding the supercharger network, and investing in battery production. Revenue was growing, yes, but expenses were growing faster. Wall Street analysts looked at the numbers and saw a company that might never be profitable. They saw production delays, quality issues, and a CEO who seemed more interested in tweeting than managing. They saw a car company valued like a tech startup, trading on hype and promises rather than fundamentals. And so they began to short the stock. Shorting is a betting strategy where investors borrow shares of a company, sell them immediately, and hope to buy them back later at a lower price, pocketing the difference. It's a bet that the stock will fall. And in Tesla's case, many very smart, very experienced investors believed the fall was inevitable. They pointed to the competition. BMW, Mercedes, Audi. Every major automaker was developing electric vehicles. Once they entered the market with their superior manufacturing expertise and economies of scale, Tesla would be crushed. They pointed to the cash burn. Tesla was spending money faster than it was earning it. Without constant fundraising, the company would run out of cash and collapse. They pointed to Musk himself, erratic, combative, stretched thin across multiple companies, a liability, not an asset. The short interest in Tesla, the percentage of shares sold short, climbed steadily. At one point, it became the most shorted stock in the US market. Billions of dollars were bet against the company's survival. Musk took this personally. Very personally. He began referring to short sellers as value destroyers, people who profit from failure rather than contributing to innovation. He tweeted insults, made jokes at their expense, and even sold short shorts, red satin shorts with S3XY printed on them, mocking those betting against him. But beneath the bravado, there was real tension, because the shorts weren't entirely wrong. Tesla was fragile. One bad quarter, one production miss, one recall or regulatory issue, and the whole house of cards could collapse. In 2018, that nearly happened. Tesla was ramping up production of the Model 3, a more affordable sedan priced at $35,000. It was the car that was supposed to bring Tesla to the masses, the final step in the master plan, but the production ramp was a disaster. Musk called it production hell. The factory couldn't produce cars fast enough. Robots failed. Suppliers missed deadlines. Quality control was inconsistent. Musk began sleeping on the factory floor, personally troubleshooting issues, working 100-hour weeks. The company was burning through nearly $1 billion a quarter. Analysts predicted bankruptcy within months. The stock price wavered. Short sellers circled like sharks. And then Musk did something that would change everything. On August 7, 2018, at 12:48 p.m., Musk tweeted, "I'm considering taking Tesla private at $420, funding secured." The stock market froze, then exploded. Taking a company private means buying out all public shareholders and removing the stock from public exchanges. It's a massive, complex undertaking, especially for a company worth tens of billions of dollars, and Musk was claiming he had the funding to do it. The stock soared. Short sellers panicked, scrambling to close their positions. In minutes, billions of dollars changed hands. The trading halt was triggered multiple times as the system struggled to process the chaos. But there was a problem. A very big problem. Musk didn't actually have the funding secured. Not in the way that phrase is understood in financial markets. He'd had a conversation with the Saudi Arabian Sovereign Wealth Fund about potential investment, but nothing concrete, nothing contractual. certainly nothing that justified the definitive language of funding secured. The tweet was, at best, premature. At worst, it was securities fraud. The Securities and Exchange Commission, the regulatory body overseeing financial markets, launched an investigation. Musk's own board was blindsided, learning about the plan from Twitter like everyone else. Shareholders filed lawsuits. Short sellers, who'd lost billions in the initial surge, cried foul. Musk defended the tweet. He claimed he was rounding up the potential price to $420 as a joke, a reference to cannabis culture, something he thought his girlfriend Grimes would find funny. He insisted his intentions were genuine, that he was trying to protect the company from the volatility and pressure of public markets. But intentions, in securities law, matter less than facts, and the fact was that the tweet moved markets based on information that wasn't accurate. The SEC filed charges. Musk faced the possibility of being barred from serving as an officer or director of any public company, which would effectively end his leadership of Tesla. At the last moment, Musk settled. He agreed to pay a $20 million fine. Tesla paid another $20 million. Musk stepped down as chairman of the board but remained CEO. And crucially, Musk agreed to have his public communications, especially those related to the company, pre-approved by Tesla's lawyers. That last condition Musk largely ignored. The tweet saga became legend. It was referenced in memes, articles, documentaries, and courtrooms. It crystallized Musk's public image: brilliant but reckless, visionary but chaotic, a man who could build rockets and electric cars but couldn't resist trolling his critics on social media. But here's the strange thing. Despite the legal trouble, despite the fines and the scrutiny, Tesla kept growing. The Model 3 production ramp eventually stabilized. The company began posting profitable quarters. Sales grew. The stock price, after dipping during the SEC investigation, began climbing again. And then it really began climbing. By 2020, Tesla's stock had entered a realm that defied traditional analysis. It wasn't just rising. It was soaring, skyrocketing, entering what financial analysts call a bubble, though saying so publicly often invited harassment from Tesla's fervent online fanbase. The stock split 5-for-1 in August 2020, making shares more accessible to retail investors. This triggered another surge. By the end of 2020, Tesla's market capitalization had surpassed every other automaker in the world combined. Toyota, Volkswagen, Ford, GM, BMW, all of them together weren't worth as much as Tesla alone. How was this possible? Tesla sold a fraction of the vehicles these companies produced. Its profit margins, while improving, were still slim. Its revenue was dwarfed by legacy automakers. The answer lay not in what Tesla was, but in what it represented. Tesla wasn't valued as a car company. It was valued as a tech company, an energy company, a mobility company. Investors weren't buying the present, they were buying the future. They believed in autonomous driving. Tesla's autopilot and full self-driving features, while controversial and still far from fully autonomous, represented a potential future where Tesla operated a fleet of robo-taxis, generating revenue without needing to sell cars. They believed in energy storage. Tesla's battery technology, its solar panels and power walls, positioned it as a key player in the renewable energy transition. They believed in Musk. Whatever his flaws, he delivered rockets that landed themselves, electric cars that outsold their combustion competitors, and a personal brand that turned every product launch into a cultural event. And they believed because others believed. Stock prices, especially in the short term, are driven as much by sentiment and momentum as by fundamentals. When a stock rises, it attracts buyers. Those buyers push it higher, attracting more buyers. It becomes a self-fulfilling prophecy, a feedback loop of optimism. Tesla's retail investor base was unlike anything Wall Street had seen. These weren't just shareholders. They were believers, evangelists, members of a tribe. They made memes celebrating the stock's rise. They organized online forums to discuss every detail of the company. They attacked critics with coordinated fervor. Musk encouraged this. He tweeted memes, replied to fans, and positioned himself as the rebel fighting against the establishment, the visionary mocked by the conventional, the outsider proving the experts wrong. It worked. The stock hit heights that seemed absurd. Analysts who maintained sell ratings were ridiculed. Short sellers, many of whom had been betting against Tesla for years, lost unimaginable sums. By some estimates, shorts lost over $40 billion on Tesla, making it the most painful short trade in history. Musk reveled in their losses. He posted memes showing short sellers in tears. He sold those shorts. He named one of Tesla's supercharger locations in a way that mocked a prominent short seller. But not everyone was celebrating. For every believer, there were skeptics who looked at Tesla's valuation and saw madness. They pointed out that Tesla's profits, while positive, were often dependent on regulatory credits, payments from other automakers for exceeding emission standards. Without those credits, the profitability was questionable. They noted that competition was arriving. Traditional automakers were launching electric vehicles with quality, dealer networks, and brand loyalty that Tesla lacked. Startups like Rivian and Lucid were entering the market with fresh designs. They highlighted quality control issues, panel gaps, paint defects, inconsistent build quality. Consumer Reports and other organizations documented problems that would be unacceptable in vehicles from established manufacturers. They questioned the autonomy claims. Full self-driving, despite its name, was not fully autonomous. It required constant driver supervision, and its safety record, while Musk claimed it was superior to human driving, was difficult to verify independently. Most of all, they questioned the valuation. Even if you believed in Tesla's future, even if you granted that it would dominate electric vehicles, energy storage, and autonomy, did that justify a market cap greater than the next 10 automakers combined? It was a philosophical divide. On one side, those who believed markets are rational, that prices eventually reflect reality. On the other, those who believed markets are narratives, that prices reflect belief, and belief can create its own reality. Tesla's stock became a Rorschach test. What you saw in it revealed more about your worldview than about the company itself. And through it all, Musk kept tweeting. He tweeted about production numbers, new models, battery technology. He tweeted jokes, memes, and insults. He tweeted about Dogecoin, a cryptocurrency that began as a parody. He tweeted during earnings calls, during SEC investigations, during middle-of-the-night arguments with random critics. Every tweet moved the stock, sometimes up, sometimes down, but always movement, volatility, attention. In May 2021, Musk appeared on Saturday Night Live. During the show, he joked about Dogecoin, calling it a hustle. The cryptocurrency's price plummeted instantly. Billions in market value evaporated because of a joke on a comedy show. This was the new reality. A CEO's words, unscripted and unfiltered, could move markets in real time, not because of earnings reports or product announcements, but because of sentiment, memes, and the cult of personality. Traditional investors found this baffling, even offensive. Markets were supposed to be rational, driven by analysis and fundamentals. This felt like a casino, a popularity contest, a reality show masquerading as finance. But younger investors, those who'd grown up with social media and influencer culture, understood it instinctively. This was how the world worked now. Attention was currency, narrative was value, and Musk was the master of both. Tesla's stock continued its wild ride. It peaked in late 2021, briefly valuing the company at over $1 trillion. Musk became the richest person in the world, surpassing Jeff Bezos. The rise seemed unstoppable. And then, as with all market manias, the turn began. Interest rates started rising as central banks fought inflation. Tech stocks, which had soared during the pandemic, began falling. Tesla was no exception. The stock dropped 20%, then 30%, then 50%, from its peak. Musk's attention was increasingly divided. He'd become obsessed with buying Twitter, the platform that had been so central to his public persona. He made an offer, tried to back out, was sued, and eventually completed the purchase for $44 billion in October 2022. The Twitter acquisition was a disaster from the start. Musk gutted the staff, alienated advertisers, and spent his days posting controversial takes and engaging in online arguments. Tesla investors watched, horrified, as their CEO seemed more interested in social media drama than running the company. The stock continued falling. By the end of 2022, it had lost nearly 70% of its value from the peak. Musk lost his title as the world's richest person. Billions in market value evaporated. The believers who'd held through everything began to waver. Short sellers, bloodied but not beaten, saw vindication. They'd been right, they said. The valuation was absurd. The cult of personality was cracking. Reality was finally asserting itself. But then, as 2023 began, something strange happened. The stock began recovering, not slowly, but rapidly. Tesla announced price cuts that boosted sales. Production continued expanding. New factories in Berlin and Texas ramped up. The Model Y became the best-selling car in the world, electric or otherwise. By mid-2023, the stock had doubled from its lows. The shorts were in pain again. The believers were vindicated. The cycle continued. And that's the thing about Tesla. It's not a company. It's a living, breathing argument about the nature of value, belief, and markets. Is Tesla worth what it's valued at? The honest answer is it depends on what you believe. If you believe that electric vehicles will dominate within a decade, that Tesla's lead in battery technology and charging infrastructure is insurmountable, that autonomy will revolutionize transportation, and that Musk, despite his flaws, is a once-in-a-generation visionary, then yes, Tesla could be worth every penny and more. If you believe that competition will erode Tesla's advantages, that legacy automakers will catch up, that autonomy is decades away, and that Musk's erratic behavior is a liability that will eventually sink the company, then no, the valuation is a house of cards waiting to collapse. Both views can be argued convincingly. Both have been wrong and right at different times, and therein lies the madness and the beauty of it. Tesla's stock isn't just a financial instrument. It's a referendum on the future. It's a bet on whether disruption beats experience, whether vision beats execution, whether one man's tweets can bend reality to his will. For the short sellers, Tesla has been an expensive lesson in the power of narrative over numbers. Many of them, brilliant analysts with decades of experience, have been humbled by a company that refused to follow the script. For the believers, the Tesla bulls as they call themselves, the stock has been a vindication of faith over fear. They held when everyone said they were fools. They bought when everyone said it was overpriced, and many of them have become wealthy beyond their dreams. For Musk, Tesla is both his greatest achievement and his greatest burden. It's proof of his vision, but also a constant source of stress and scrutiny. Every misstep is magnified. Every controversy is amplified. He's built something extraordinary, but at a personal cost that's hard to calculate. And for the rest of us watching from the outside, Tesla is a mirror. What we see in it reflects our own beliefs about technology, capitalism, celebrity, and change. The story of Tesla and its stock is far from over. The company continues to grow, delivering more vehicles each year. It's expanding into new markets, new products, new technologies. The Cybertruck, a polarizing angular pickup, has finally entered production after years of delays. New models are promised. The dream of full autonomy persists. But the stock will continue to be volatile, driven by earnings reports, yes, but also by tweets, memes, and the collective belief of millions of retail investors who've made Tesla their cause, their team, their identity. In a way, Tesla has become the perfect symbol of our time. A company born from idealism, built through chaos, marketed through social media, and valued by belief as much as by balance sheets. Its stock price isn't just a number, it's a conversation, constantly evolving, about what we value, what we believe, and what kind of future we want to build. Whether Tesla ultimately succeeds or fails in its grand mission, whether the stock soars higher or crashes spectacularly, the company has already achieved something remarkable. It's changed how we think about cars, energy, and innovation. It's proven that a small company can challenge giants, and it's shown that in the age of social media, a single voice amplified by belief can move mountains and markets alike. So where does the story go from here? No one knows. Not the analysts, not the investors, not even Musk himself. Perhaps Tesla becomes the dominant automaker of the 21st century, the company that accelerated the world's transition to sustainable energy. Perhaps it becomes a cautionary tale of hubris and hype, a bubble that finally popped. Or perhaps, most likely, it remains what it's always been, a company that defies simple categorization, that frustrates predictions, and that reminds us that the future is not a spreadsheet to be analyzed, but a story to be written. And in that story there's room for dreamers and skeptics, believers and doubters, rockets that land and tweets that soar. As you drift off tonight, perhaps you'll think about what Tesla represents. Not just a stock or a car company, but a question. What happens when one person's vision captures the imagination of millions? What happens when belief becomes so powerful it reshapes reality? The answer, like Tesla's stock price, is constantly changing, refreshing with every new day, every new tweet, every new believer and skeptic joining the endless debate. And perhaps that's the most fitting ending for this story. Not an ending at all, but an invitation to keep watching, keep wondering, and keep questioning what's possible when technology, personality, and markets collide. Sleep well, dear listener. The stock market will still be there in the morning, ticking up and down, driven by forces both rational and irrational, waiting for the next chapter to unfold. And somewhere, probably right now, Elon Musk is composing another tweet that will make tomorrow's headlines and move billions of dollars before breakfast. The theater of Tesla never sleeps, but you can. Good night.